Welcome into Phil's Tax Hacks and Other Retirement Facts with CPA and personal financial specialist Phil Putney. Now let's get rolling with today's show. Hey everybody, welcome to Phil's Tax Hacks and Other Retirement Facts. Mark and Phil here for a Thanksgiving edition. Phil is what we got on docket. We're going to try to flip this around today, put it out a couple of days ahead of Thanksgiving. So I guess we'll say happy Thanksgiving, everybody. Hope they have a good
Thanksgiving. So
hope they have a good holiday. Hope you have a good holiday.
Yeah, you too. We've got everyone coming our way, so it's going to be a busy house, but that's awesome.
Yeah, that's what you were saying.
That's what the holidays are for. So
yeah, exactly. That's what it's for. In a weird, I don't know if this is a good segue or not, but I want to go with the a 60-40 conversation today.
Okay.
So I just want to kind of quickly touch on the fact you and I were chatting. We've been seeing a bunch of articles, lots of them here in the last week or two, about is the 60-40 portfolio dead? Yeah. And so I wanted to kind of have that chat quickly this week and talk about that to see your take on it. You know, I don't know, maybe the analogy or the tie-in to Thanksgiving would be maybe you're kind of a 60-40 person. Maybe you're like 60% potatoes, what is that? Sweet potatoes.
Sweet potatoes, yeah.
And maybe you're 40% mashed potatoes, or maybe you're the other way, you know, or if you're down here in the South, it's collard greens or, you know, whatever.
Collard greens, yeah. No, we don't do collard greens, but yeah, we do sweet potatoes.
There you go.
I like sweet potatoes. So,
or maybe you're like, you know, maybe you're just you're a meat and potatoes kind of guy. So you're 60% turkey and a 40% mashed potatoes. Anyway, that's my tie-in.
Yeah, you're tying into Thanksgiving. What's your plate look like? You know,
that's the best I could come up with on a short notice. But let's talk about it. First of all, what is the 60-40 portfolio? I think most people know, but let's just kind of clarify it. It's been a standard for a really long time. People hear it referenced often. What is it?
Yeah, it's kind of the standard moderate type allocation. So I mean, it's 60-40 referring to an asset allocation at a high level, 60% equities, you know, usually represented by the SPY, you know, S&P 500. 40% bonds, or the AGG, the aggregate bond index. Again, at a really, really high level of your asset allocation, bonds and stock and bond allocation.
Right.
So
And the traditional thinking, and we did a bond show not too long ago. Mm-hmm. The traditional thinking is, and it's usually been when the markets get rough, like they've been in 22, you move to bonds, and when you get older. For safety, you move to bonds. But the bond market this year is down about 15%. So that's probably leading some of the conversation, I would assume, Phil, about is the 60-40 dead? So I'll go to that. What's your thought on the 60-40 in general as a philosophy or as a portfolio design?
Well, I mean, to me, it's like any of those rules of thumb, right? Or standards in retirement. I can take 4% of my portfolio, or I mean, there's 100 different rules of thumb. And I think we talked about some of those before that. Yeah, on average, most of the time it works out. And I mean, the 60-40 has worked for many years.
Yeah.
The challenge with that you mentioned is the bonds. And I mean, if you look at that bond component over the last about 40 years, really, the bond component has had kind of a double benefit, you know, because I mean, historically bonds are a little bit more stable because and we've talked about the difference between the stock and the bond, right? So the bond is that guarantee the company is going to pay, right? It's a note. They have to pay you back the money with a certain fixed interest rate, whatever that bond calls for. And as long as you're holding the bond to maturity, you're going to get that money, you know? So, I mean, you have that security of, okay, well, it's not going to fluctuate in value as long as you hold it, and you're going to get X interest rate, whatever it is, you know? So that stability is there. And in the tailwind that bonds have had over the last 40 years is that as interest rates have fallen, that causes bond values actually to go up. So if you do end up selling it, you get a premium on the bond when you sell it. So, I mean, it's been a real good kind of balancer in that stock bond portfolio that, I mean, there's been years that, frankly, the bond portfolio has outperformed the stocks, you know, pretty handily, you know, in returns. You're thinking, how did this happen in a bond portfolio? But that's the reason is there's been this tailwind behind it as interest rates have fallen.
And to your point, it's been that way a long time, but
the rates peaked back in the mid 80s. Think back when inflation, right? I mean, we're talking now inflation's, you know, rates like we've seen back near the 80s. So
early 80s. Yep.
We're starting to have that discussion again. Well, that's when this bond market had peaked back then. And it's been this gradual decline ever since. I mean, the funny thing, when you really start to look at the 60-40 portfolio, I mean, it's hitting the headlines today because bonds are, to your point, they're they've gotten really
like
hit
I said,
hard this year.
15% on average, somewhere in that neighborhood.
Right.
And you've got
Yeah.
different indices that are anywhere from 15 to 30% down this year. So
Right.
they're getting a lot of conversation.
Yeah. So I mean, all of a sudden you're thinking, wait, I thought this was the secure part of the portfolio that was supposed to hedge against, and I mean, yeah, typically when people exit equities, they're thinking of bonds, they'll go into bonds, but this year people have actually gone to cash more.
Right.
Because bonds are down too. So I mean, it's not that safety net anymore.
Yeah, exactly.
But I think the headlines have really gotten a lot of attention this year because bonds are down. But the reality is that 60% or the 40%, the bond component has struggled for the last probably 5 to 7 years because
exactly. Yeah, it's
interest rates bottomed out, and think of how long we've been at this, near 0% rate, just kind of bouncing along the bottom for quite a few years. But what happened during that time frame is equities were really good. So I mean, it kind of covered up the bond side of the portfolio, that you were having some safety, right? There wasn't the loss of value. But I mean, as interest rates have fallen, bonds no longer generated revenue like they used to.
Right. So, and more people were moving and taking more risk in the market because the market was on a 12-year run, really.
Right. So they're thinking, I'm not going to, why would I go into a bond? It's only paying me 2%. I mean, the market's giving me 10, why would I go into a bond?
And so if you're thinking about the risk allocation, 60-40, people have been taking more than 60 in equities because the market's been so good. But, to our conversation numerous times, this year's been rough. Some people were ahead of the curve. Some people were working with an advisor that was helping them be strategic. And maybe they started to kind of, peel back some of the winnings, if you will, take some off the table. And they've kind of bringing that down. But now with the bonds being down, it also makes that side screwy. So I guess if you're trying to find that traditional role, if you're trying to go, let me get a little closer to the 60-40 because, of the different things we just covered, but bonds don't get it done. Is there an alternative? Is there something to think about for that 40% of the safety, I suppose?
Yeah. So, I mean, in the bonds, you group the whole bond portfolio as, one, bonds. But I mean, the reality is with bonds, the piece of that portfolio that is affected more is longer term bonds.
Okay.
So those are the ones that are really getting hurt on the downside, as interest rates have risen, because just the length of time that bond has to be held to maturity, that you're locked into this lower rate. So moving to a shorter term bond is going to help the duration.
Okay.
And now that you have those shorter term bonds, they're going to mature, and come back into the market at a higher rate quicker.
Okay.
So maybe not scrapping the whole thing, but moving to a shorter duration or starting to look at alternatives. I mean, there's a lot of other alternatives, could be some kind of an equity that's generating dividends, Challenge there is it's still an equity, even though it has a dividend, it's an equity, it's going to have volatility, and dividends aren't guaranteed. It's not like a bond that my bond is paying whatever that bond says. The company doesn't have an option. They can't say, I'm not going to pay the interest this month.
Yeah.
The bond says what it's going to pay. Or looking at other type of equities, REITs are, another one that generate higher dividends because it's generally tied to rents. Although you get into the real estate market right now,
people are a little nervous right now because that's we expect that to be bad next year. They're saying, or they feel it's going to maybe not bad, but I guess level out or something like that. I think people feel like we're in this perfect storm of, I don't really, like we always hear, I don't know what to do, right? That's kind of always a thing when you're unsure about the whole financial world. But people really are struggling right now because it's like, well, the market's not a good bet. Bonds aren't a good bet, it sounds. Real estate may not be a good bet. Like, what in the world do we do? That's why people are thinking cash, right?
Right. Cash right now is really not paying much, although it's paying more than what it was, but at least you're not losing value, and it's short term, because that's the challenge with any kind of a bond, is that even if you wanted to jump into bonds today, well, number one, you're not going to get the interest rates that are at the higher level today, right? Because you'd have to buy a new issue, basically. Companies that are issuing bonds today, there's millions and millions of dollars of bonds that are out there that, are somewhere in the middle of their maturity at whatever the fixed interest rate is. And companies have a lot of these locked in at these lower interest rates, so those have to kind of work their way through the system for years. So,
yeah.
But
I was gonna say cash is interesting too because
Yeah.
people are thinking about it and they're like, well, the interest rates are going up, so I could probably get more at the bank because we know that the interest rates have been terrible. But most banks are not advertising; they're not that great, really. Still,
No, I
now
mean they've started to creep
they've
up, but it's
started
still
to.
not,
Yeah, I
anywhere
think
near what people might expect.
working with someone like yourself, you guys have access to a lot of other stuff where
Right.
it's like, okay, I can probably get you a little bit better rate than the bank, than
Mhm.
your local bank because they're just
Absolutely.
not advertising that, right?
Right. Yes. I mean, there's other options, annuities. They're a great option, a bond alternative. They have similar characteristics, so to speak, that a bond might have had as far as
On that
safety of
safety
principal,
side, yeah,
the paying a fixed interest rate. I mean, there's a different types of annuities you can use.
right.
So, I mean, that's an option. To me, it really comes down to, you've got to take this concept of diversification, and the whole reason you're doing it is when one's down, the other one's up. They help balance each other out. But understand that concept and what you're trying to do, but be comfortable thinking outside the box, right? It's no longer stocks and bonds, and I mean, we've gone into asset allocation to kind of spread that out even further, where it's not just one type of bond or one type of stock. I mean, that helps some, but at the end of the day, it's stocks and bonds. You've got to be comfortable kind of expanding that concept a little bit and taking maybe that 40% that you would have put into bonds and not totally scrapping bonds, but maybe changing the allocation of bonds to not the longer duration, maybe shorten it up as we're going through this increase, and maybe a portion of that 40% put it in something else, like an annuity or like, some other income generating alternative, commodities. I mean, but it gets down to risk, and that's, I think people have to really be comfortable with knowing that bonds aren't what a lot of people think of as the risk-free alternative, right? I mean,
Well, and I'm glad you brought that up.
Risk.
Because I was going to ask you, is it worth scrapping bonds altogether, right?
Right.
And it sounds like no. Obviously, we don't want to completely scrap it, but we need to be a little more strategic. Maybe those shorter durations, like you were talking about.
Right.
And to me, it feels like now more than ever. So back to the main question: is the 60-40 dead? It feels like now more than ever, it's a good idea to get a professional because it's the nuance. And we've talked about this a number of times on probably a ton of episodes, Phil, where when the market's going up the way that it had for years and everything was looking fairly rosy, it didn't take a genius, to do a pretty good job. It's when times are tough. It's when things are not going well that, really advisors can really, kind of, I don't know, I guess they're worth their weight in gold, so to speak, right? Because you guys have access to more stuff. You've seen more stuff, especially like someone like yourself who's got years of experience, and you kind of can really kind of look for a more nuanced, purposeful plan than just the normal stuff that it's kind of the low hanging fruit that we're used to doing. Does that make sense?
Yeah, and I mean, there's a lot of interesting products out there now. We can get into structured notes is another one. I mean, it's generally they're set up by a bank, and they have some downside protection, not always 100% down, but there's a lot of alternatives, To me, it really comes back to, again, taking that concept of asset allocation, diversification, but not getting stuck in, well, this is how it has to be. It's like everything else in our world has changed over time. But modern portfolio theory and that concept, I think people get kind of locked into, and well, this is how it's always been done, right? I mean, eight tracks tapes, they still work. I mean, if you can find the tape in the player, but that just doesn't. People don't do that anymore.
Are you putting an 8-track in your camper?
Yeah, that's right.
Yeah.
I don't even know if you can find them anymore.
Yeah, exactly.
If you do, you probably pay a fortune for them. But
and you probably can't find many tapes to put in.
Right. Or even CDs. I mean, it's funny to me, CDs now. I mean, those used to be the thing. Well, you don't even see CDs anymore. Now streaming. It's
they're
all
making a little. That and vinyls made a little bit of a resurgence, but vinyl for sure. But no, and that's a great point. So, is the 60-40 dead? Probably not, but it's certainly wounded. Right.
Yeah. I mean, as a set it and forget it, 60-40 stock bond allocation, I would say that's dead, right? I mean, you have to be comfortable with understanding the purpose of why it was there. The whole reason it was designed was asset allocation, that ebb and flow, the bonds and the stocks, they kind of worked in opposite directions to help balance it out and make a more balanced portfolio through time.
A balanced Thanksgiving.
That concept still works, but now you've just got to be comfortable with what the makeup of that isn't necessarily just stocks and bonds.
Yeah, exactly. Exactly.
We're in a different world than we were back then. So,
oh, for sure. Well, back to my Thanksgiving plate analogy, right? So
that's right.
we'll kind of tie it all up. So you don't want just 60% turkey and 40% mashed potatoes. You want a little turkey and a little mashed potatoes and a little sweet potatoes and a little stuffing,
green bean casserole in there,
and a little
all
green
these
bean
different
casserole and a little collards and a little bit of cranberry. You want a bunch of stuff. Phil, it sounds like we're describing asset allocation, right?
There you go. That's what it is. That's ultimately what it is. So.
Yeah. And so basically, at the end of the day, you got to have a good balanced setup. And right now, it is tough. I get it. People, for those of us who don't do this every day, I mean, I'm the host, right? But I talk about this stuff, so I know a little bit more. But at the same time, for the average person, they just don't know. We've talked about it a million times, Phil, and I'll wrap it up with this. People think that their options are cash in the bank or money in the stock market, right? And I think they would kind of say, okay, well, the bond thing is, they kind of consider that like the
part of the
investing
market.
side. And then the cash side. There's a lot of other alternatives. There's a lot of stuff, but it is challenging right now. And that's why it's important to talk to a financial professional, work with somebody, make sure that you've got somebody on your side to help you get, through these kind of things, especially again, when times are down. It's a little tougher, right? It's not as easy. So reach out to a pro, talk to somebody like Phil, get on the calendar. I know it's Thanksgiving week. If you're catching this, if you need some help, make yourself a note or take the time to stop by the website or something, whatever the case is, but do something for yourself and your retirement. Reach out to Phil at philstaxhacks.com. That's philstaxhacks.com. Don't forget to subscribe to us on Apple, Google, Spotify, all that good kind of stuff. And you can reach out to him if you've got some questions and get on his calendar as well, even if it's for later on in this year or even the first of next year. So do yourself a favor and also have a good Thanksgiving, right?
Yeah. Happy Thanksgiving.
Yep. We'll catch you next time here on Phil's Tax Hacks and other retirement facts.
Investment advisory services offered through AFS Wealth Management. The content of this program is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. Investments and/or investment strategies involve risk, including the possible loss of principal. There is no assurance that any investment strategy will achieve its objectives.